passed the Profem challenge phase in just 4 days, and in this video I'm going to be showing you a trading strategy that I used to pass this Profem challenge and how you too can apply the same strategy to your own trading. If you've been following this channel for a while, you already know that I trade BTMM, also known as Beat the Market Maker. For those new to the channel, my name is DanFX and I teach people how to trade in line with the market makers and market manipulation for free on this YouTube channel. So make sure you subscribe to the channel to get more of my videos on your homepage. So without wasting any more time, let's get into the charts.
So before we move on, the first thing you need to know is there are 3 main types of M and W formations. So we have the standard formation, which is a type 1 formation here, while the rest are just variations of this same pattern, the M formation, W formation, double top, double bottom, whatever you want to call them. So we have type 1, which is the normal M formation where you have equal highs. So the M formation is going to have equal highs. The second leg is going to be equal. It's going to be at the same level with the first leg. While on the second variation, which is the type 2, the second leg in this example is going to be below the first leg if it's an M formation. If it's a W formation, it's going to be above the first leg. So the second leg is going to be above the first leg on the W formation, and on an M formation, the second leg is going to be below the first leg. So the second leg attempts to get to this first leg but doesn't actually reach there, comes close to it, and then reverses from that point. So that's how the type 2 formation forms. The type 1, remember, is equal highs and equal lows for W formation. The second one, the second leg doesn't quite get to the first leg. Then the third variation is where you have a stop hunt on the first leg, where the second leg goes past the first leg, slightly goes past the first leg, not too much, just slightly, breaks above and then enters back in, or maybe spikes it. Sometimes they might throw a wick. Sometimes it might be a candle close above, and then it's gonna come back in with the maybe 2 candles, or sometimes it might be a wick. So sometimes it might be like this, right? You might have equal highs, but then you're gonna have a wick going up like that, just like a type 1, or sometimes with a wick like this. So if you have a wick like this, that's a type 3 pattern. The type 1 is if you don't have any wicks above that goes past, that it doesn't go past this first leg. But the type 3 can look like the type 1 if it doesn't break above, if it just throws a wick above. So just to clarify that. So we have the type 1, type 2, and type 3. This is going to be important for you to understand when trading this strategy. The W formation is just an inverse of this. So W formation is just an inverse of this whole pattern here. So everything inverse, right? So how exactly does the strategy work? So we're going to be trading M and W formation. This is what we're going to be using to enter the trade. We're going to be entering the trade. We're going to be selling somewhere in here on the second leg. So let me just explain the strategy, how it works. So first of all, the foundation of the strategy is like this. You're going to have, we know that there are 3 main forex trading sessions. We have the Asian session, the London session, and the New York session. And I've explained this concept many times in my videos, in my YouTube videos. But if you're new to the channel, pay attention, because I'm going to explain this a little bit more. So I'm going to just briefly go through this, then I'm going to go to the main strategy. But this is the foundation of the strategy. So we have 3 main sessions: the Asian session, the London session, and the New York session. The Asian session, each session has its own characteristics, right? So the Asian session, the characteristic of the Asian session is to consolidate. That's the purpose of the Asian session. So market makers use that time period for consolidation. And the purpose of that consolidation is to create liquidity, is to create contracts, right? So get people to buy and sell inside here, because inside the consolidation zone is where you have support and resistance. All right, so the above is resistance, below is support. So what's going to happen is, during this consolidation, price is going to be bouncing off of support and resistance like this. It's going to be bouncing off of it. People are going to be buying and selling. That's why they call it accumulation. They are accumulating contracts, accumulating orders inside this zone, which is going to also directly lead to people having their stop losses above and people having their stop losses below. People that are buying are going to have their stop loss below. People that are selling are going to have their stop loss above. So what's going to happen is price is going to eventually break out of this consolidation, either to the upside or to the downside. Let's say in this example, price breaks to the upside. When price breaks to the upside, there are many things that this move does. It does 2 things. One, it hits the stop loss of the people selling, and also at the same time induces people to take buys, to buy the breakout. So when price breaks to the upside, price is gonna pause, and then when price pauses like that, it's gonna pull back and then go back, attempt to go back to this first leg. So this is gonna form the first leg like this. The first pullback is gonna form the first leg. The price is gonna begin to consolidate, then form a second leg, and then price is gonna reverse back down. All right, so this is the pattern. The inverse pattern of this would be where you have the consolidation, price breaks to the upside, price breaks to the upside. Let me use this. Price breaks to the downside, gives you a W formation, and then goes back up. So this is the foundation of the strategy I'm going to show you. All right, so now one thing you have to also take note is that the way they form the M and W formations is actually very important. They form the M and W formations based off of time. So what's going to happen is when they are forming the M and W formation, price is going to set the high of the day and then pull back. All right, so we know that we have the consolidation here. Price breaks to the upside. This initially is going to be the high of the day. So that's going to be HOD, high of the day. All right, so then price pulls back. Immediately price pulls back from this high of the day. What's going to happen is price is going to begin to consolidate for at least 45 minutes to an hour, and ideally 2 hours, 90 minutes to 2 hours. Price is going to begin to consolidate and then attempt to go back to this high. So when price attempts to go back to this high, that's when it forms the second leg. After that time period, price attempts to go back to this second leg. Now when it goes back to this first leg, that's where you're going to have 3 types of formations formed: the type 1 or the type 2 or the type 3 formation. So if it's a type 1, it's going to be equal highs. If it's the type 2, it's going to attempt to near this high and then just reverse from there. All right, and if it's the type 3, they're going to stop on this high and then come back down here. So this is where the type 1, type 2, and type 3 pattern plays out. But one thing you must also note is this pattern takes about 2 hours to form. But from the pullback, you can begin to look for a second leg about 1 hour, 45 minutes, for 5 minutes to 1 hour. You can begin to look for a second leg. If it hasn't been 45 minutes to an hour since they pulled back from this high of the day, then that is not an M formation. It should take at least 45 minutes to an hour before they attempt to form the second leg. Right? Sometimes the 1 hour candle, the candle that might form the 1 hour would be the candle that goes to form the second leg. Right? So that one is also plausible. So this is how they form the M and W formations. And then if they form the M and W formation, for example, they give you the second leg and then you enter the second leg. If you enter the second leg, you're going to count another 2 hours. Let's say you sell here, you're going to count 2 hours. So if after 2 hours you sell this, after 2 hours you're not in profits, then you have to exit the trade, because at that moment there's a high probability, very high probability, that they're going to break this M formation, maybe stop once and then make one more move down, or just continue up. Maybe they're not ready to reverse for the day or that session. All right, so after 2 hours, this is the scratch out limit. Once it's 2 hours and you're not in profit, if you entered on the second leg of an M or W formation, after 2 hours, close the trade if you're not in profit. If you're in profit, you can leave the trade. If you are in loss, if you're in drawdown, close the trade. All right, so let me give you the breakdown of the strategy. That's just the foundation you need to know in order to understand the strategy I'm about to show you. So the way the strategy works now is the same pattern that I just showed you now. This same pattern that we have here, where we have the consolidation, price breaks to the upside, it gives you an M formation, and then price reverses, or sometimes give you a W formation down here. So up here is going to be an M formation, while down here is going to be a W formation, right? So this pattern is usually on the 50-minute chart. You can only see this on the 50-minute chart, but on a larger scale, if you're going to expand that on a larger scale, which is going to be on the 1 hour chart, you're going to expand it. So the Asian session for the week is going to be the first Asian session for Monday. So the Asian session for the week is the first Asian session for the Monday. It's the first 8 hours on Monday. All right. So now price is going to form So you can see Monday, Tuesday, Wednesday, Thursday, and Friday. You can see them down here. So what's going to happen is price going to consolidate during the Asian session on Monday. Tuesday, sorry, on the London session on Monday, price is going to break, let's say, to the upside. It's going to break to the upside and form the high of the week. And then price is going to pull back from there and then end the day in consolidation, right, going into Tuesday. So now this is going to be what? This is going to be the high of the week, which you're going to abbreviate as HOW, high of the week, HOW, right? So this is the high of the week. Price is going to pull back and they end the day in consolidation. It's necessary that price pulls back before they end the day. So they have to pull back and end the day in consolidation. They can't just end the day at the extreme highs. They have to pull back away from this high and begin to consolidate. So when they pull back away from this high and begin to consolidate, what's going to happen is Tuesday. Now, this can happen on Tuesday, it can happen on Wednesday, it can happen on Thursday, and it can happen on Friday. So if by Tuesday they're still consolidating and the price is going to eventually go back to this high, to retest this high, and then this is on the 1 hour chart, all right? So this is going to be on the 1 hour chart. So when price goes back to this high here, we're going to jump to the 15-minute chart to look for an M formation inside that. So we're going to be looking for this same pattern on the 15-minute chart, which is also the same pattern on the 1 hour chart. So it's just the market is fractal. So what happens on a higher time frame happens on the lower time frame. What happens on the lower time frame happens on the larger time frame. So this is the structure that we're looking at here. This is the structure that we're looking at here. And this takes multiple days, maybe 1 day, 2 days, 3 days, 4 days, which if you go on a 15-minute chart, is still the same thing that occurs, right? So we're going to be looking for an M formation on the 15-minute chart to take this on a short at the highs here. Right, the same thing goes for the W formation. I'm not going to be explaining the W formation because I'm going to be basically repeating myself. So anything I say for the M formation, just invert it. That goes and works for the W formation. All right, so now what you're going to do is for you to get a 1 to 4 risk to reward on this trade, you need to use limit orders. If you're entering manually, I think the max you can get, if you're not swinging your trades, if you're day trading, I think the max you can get is about a 1 to 3 risk to reward, sometimes a 1 to 2. A 1 to 2 is more consistent. If you're entering manually, that's waiting for candle confirmations and all that. If you want to watch the video on candle confirmations, you can check out my channel. I have the videos on that, but I'm not going to be explaining that in this video. What I'm going to be explaining in this video is limit order. So I'm going to be using limit orders to enter at this highs to like basically catch a sniper with zero drawdown entry. All right, I've not really explained this on this channel before. This is the first time I'm going to be explaining this, so I'm going to be using limit orders. So let me just show you guys a couple of examples of what I'm talking about. So once you have the high of the week here and price comes back on Tuesday or Wednesday or Thursday to form this structure, taking multiple days, the multi-day M and W formation. So the M and W formation takes multiple days. It basically means you have a first leg on 1 day, and the next day you have a second leg like this. This is your multi-day M formation. It means it takes multiple days to form. Now that same structure can occur on any day. So for example, we have our consolidation here on Monday. If price breaks to the upside and doesn't pull back to consolidate, then the next day probably continues up. They can pull back maybe on Tuesday and then end the day in consolidation. Then the structure starts on Tuesday. This is the first leg, the high of the week, HOD. All right, high of the week. Then maybe on Tuesday, maybe on Wednesday, price is going to come back and do this. Now this same thing can happen either on Tuesday, Wednesday, can happen on Wednesday, Thursday, can happen on Thursday, Friday. Sometimes it can take multiple days. So they might decide to consolidate throughout Wednesday, just move around like this. Then maybe on Thursday, come back to this high and then reverse. So this took 1 to 3 days to form, right? Sometimes you can extend it to Friday. So you get the gist, right? So I'm going to show you guys a couple of examples of how I use the limit orders to enter these trades and catch a 1 to 4 risk to reward. So let me just show you guys the example real quick. So here's a picture example of what I'm talking about. This is an M formation here. Let me grab my pen so I can draw out. Right. So We have the Asian session consolidation that happened up here. So most likely this area here is going to be the high of the week. All right. So we probably have a push and then a pullback, then price begins to consolidate, and then this is the second leg of the second leg, right? So we have the M formation that formed here. Our entry is going to be on the close of these two candles. So what do I mean by that? When price goes to the upside, you can see price breaks out of this Asian range, breaks all the way up, and then all of a sudden it pulls back, right? So you can see this pullback here. So price pulls back. Now you're going to begin to count 1 hour to 45 minutes to 1 hour. So let's count. You're going to count from here 1, 2, 3. So 3 candles is 45 minutes. 3 15-minute candles is 45 minutes. So this is 45 minutes already. Once it's 45 minutes, you can see that they were consolidating in this area. Once it's 45 minutes, you simply put your limit order at these highs at the close and open of these two candles. So you can see where this candle closed. You put your limit order there, stop loss above these highs. You have to put a stop loss somewhere in here. Give some room for the trade to breathe, because sometimes it can give you the type 3 pattern, which is this, where the second leg goes past the first leg, right? So you enter here, the price comes to activate your limit order and then goes into profit almost immediately. You can see the only drawdown you suffer is just this wicks that just appeared up here. No candle closed above. Price goes back to your TP. That's a 1 to 4 risk reward right there. All right. So the next trade here, we have the same thing. Asian session consolidation, price breaks to the upside, and then pulls back down here. So you can see the pullback started somewhere here. All right. So begin to count 1, 2, 3, 4, 5. This is 5 candles. That's about 1 hour 15 minutes. You put your limit order at the close of these candles. Just put at the close of the body of the candle, and then put your limit order there. You can see price came to touch the limit order. Your stop loss goes above, away from the reach of the market makers. You can see that price closes above, enters back in. By the time it enters back in like this, forming the second leg. Normally on a manual entry, you're going to enter down here or maybe up here, but most likely down here for extra confirmation. This would have, instead of entering up here, you would have entered down here on a manual entry, and you can see that would have been a late entry. Your stop loss would have been up here. That's maybe this would have been maybe 1 to 1.5, highest 1 to 2. I don't really think it's going to even be up to 1 to 2, but because your entry is at the highest here, this is going to be a 1 to 3 or 1 to 4. Right. So you can go for a 1 to 3 or you can go for a 1 to 4 on this trade. The next example here, we have the same thing, Asian session consolidation, price breaks to the upside, price pulls back. So you can see they set the high here, they pull back. You count 1, 2, 3, 4. 4 candles, that's 1 hour. Put your limit order here. You can see price came and touched the limit order, putting you in the trade, shift away. Manual entry would be down here, but because you're entering on limit orders, your entry is up here. It's a 1 to 4 risk reward. It's a 1 to 4 risk reward on this trade. The next example here, I remember taking this trade. You can see that price from the Asian session consolidation breaks to the downside, pulls back. All right, we begin to count 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. You can basically see this is more than even 2 hours, which is actually nice. So you put your limit order down here. You can see price came, touch the limit order, stop loss goes down here. You can see this went for a 1 to 3. I entered this trade for a 1 to 3 up here. All right. Here's another example. Now all this is on the 15-minute chart. In case you don't know, this is on the 15-minute chart. All right. So we can see price forms this Asian session consolidation, breaks to the upside, pulls back. You begin to count 1, 2, 3, 4. That's 1 hour. Right. Set your limit orders. You can see price came, touched the limit order. This went for a sniper, 0 drawdown entry. Stop loss goes above. You can see price came all the way to your take profits. Easy. Another example here, Asian session consolidation. All right, price breaks to the upside. You can see price sets the high of the day, price pulls back 1 2 3 4 5 6 7 8 9 10. That's 2 hours. Set your limit orders above. Price came, touched the limit order, putting you in the trade. You can put your stop loss above. Price went down straight to your take profit for 1 to 4. If you guys found this video helpful, click the like button, subscribe to the channel for more content like this, and if you have any questions, leave that in the comments and I'll see you guys on the next one. Also, join the free Telegram group in the description. The link will be in the description below, and I'll see you guys later. All right, peace.